Good morning. Truth be told, no one really knows how the future financial or monetary system is going to look like. But we've had a glimpse. We've seen profound changes. Take a look at tokenization. They say that it has the potential to transform capital markets. And according to McKinsey, it expects $4 to $5 trillion of tokenized digital securities to be issued by 2030, and that's just an estimate. Given how the evolution of technology has gone, the estimate could be even higher than that. So let's get a glimpse, insights on how that future financial system may look like. Of course, Bill, Jeremy, no stranger to us all. Bill, it wasn't too long ago that people were saying that, perhaps fintechs will displace traditional banks. Hasn't happened. You're back stronger, innovated. Give us a sense of the innovation that you see right now in traditional banks, because some of them are already at the cutting edge of financial innovation.
Yeah, I think for starters, we have to know that fintechs are our best friends. We partner with fintechs. We buy their services. Occasionally, we buy them. Or take an investment in them. This is an ecosystem that's very much enmeshed. Of course, there are some companies that have been set up, or including probably more big tech than fintech, that would like to skim some of the cream from the traditional banking market. That's fine as well. It's helping us all get better. So, yeah, the fact that we hear from our customers that they want a different set of products and services, or they want a different interface, it gives us the impetus, together with fintech partners, to build things like CrossB here in Singapore. 12% of the bankable population have opened up a trust account in its first year. Fastest growing digital bank in the world on a per capita basis. And there's a reason, because it's a good product and we have good partners. So, but this is together with fintech. Is that changing the nature of finance? Absolutely. And obviously some of the stuff that Jeremy's doing, and we're working with them on this, is a different set of rails. It's not the same stuff repackaged, it's different stuff. And I think to be relevant in this space, we have to do both.
So in terms of innovation, what kind of technologies excites you the most right now? I mean, we talk about AI, we talk about blockchain. What can we expect?
I think some things are tools and some things are call it instruments. And I think the ecosystem around tokenized assets, digital assets, is extremely exciting. I think it's going to take a while to get anywhere close to maturity, although it's a meaningful market for us. We're involved in many of these aspects already through a custodian that we built, a marketplace, both inside the bank, but also in ventures that we set up outside, catered to different markets, different segments. I think the way that data science is evolving, obviously AI generally, and generative AI in particular, will be transformative for our business. In many ways, that should be, certainly it's going to start doing stuff that we already do better. And over time, we know that the machines are going to be helping us develop things that we don't do today. And managing both parts of that transition will be important. The distributed ledger technology, you can pick the buzzwords. And I think 5 years ago, it'd be nothing but blockchain. That's great. Blockchain's fantastic, right? It's got some very relevant use cases. We're embracing those. Lots of things that we imagined would be distributed aren't, and that's all fine. But we've got to find a way to, and we are, in fact, finding a way to meld this stuff together.
Jeremy, Bill talked about use cases. Talk to us about stablecoin. That's the focus for Circle. Why is it such a game changer? What are the use cases?
Sure. I think the basic purpose of stablecoins is to provide a way to have a very simple store of value anchored to central bank money, so a reserved dollar, but to give it the technological capabilities of open internet distribution. So in the same way that we took paper messages and turned them into electronic messages, or we took paper newspapers and built online media, this is just a continued evolution in the form factor of the dollar, or of yen or euro, or pick your currency. So, at some level, stablecoins are just a natural evolution of electronic money. They are an evolution of the internet itself. The internet prior to this kind of development of this, blockchain technology and the like, there was no built-in notion of money, of value exchange, and so stablecoins, really provide that. And today, the use of stablecoins is expanding in lots of different sectors. So we see stablecoins obviously started and are still used as digital cash in digital asset markets. So that's a very well-known use case. But they've grown into cross-border transactions, remittance transactions, humanitarian aid, in settlements of trade finance, in tokenized securities. People are using stablecoins as the way to move cash in and out of these securities, lending markets. So many different things are happening now with stablecoins. And, I think the use cases will be as broad as the use cases for all electronic money. And then because of the programmability of these particular kinds of electronic money instruments, we'll see new things that haven't been possible in the past with money.
So stablecoins are stable. I mean,
so properly regulated stablecoins, and so this is key. And really, what we've seen happen over the last 6 months, year, and certainly happening over 2024 is every major financial market center and the regulators have come to an agreement. Actually, a lot of that came out of work that the MAS and the US Treasury were working on over the past few years. Payment stablecoins as a regulated form of electronic money in the financial system, the laws and regulations are being put in place everywhere. And so as long as you're meeting those laws and regulations and you are held to standards set by prudential regulators as both payment systems and as monetary instruments, then they'll be stable. Things that operate outside of that have a lot of inherent risk, risk of bad actor abuse, risk of abuse from a financial integrity perspective, risk of obviously the money not being there and things like that. So
I think there's some questions about the mechanism though, right? I mean, stablecoins backed by reserves. What reserves? What's the mechanism? Help us get around the whole concept.
Sure. Yeah, so for example, prudential regulators in the US, like the New York Department of Financial Services, sets a whole set of standards for stablecoin reserves, and it's essentially cash, 90-day U.S. government treasury bonds, or less than 7-day treasury collateralized repo with major banks. So I mean, basically, cash equivalency is the way to think about that. We operate under that framework, and we provide daily transparency into almost all of that through an SEC registered fund vehicle. But that effectively provides if I'm an accountant, if I'm a corporate treasurer, if I'm a financial institution, and I understand the cash equivalency, then that's tremendous. That's stable. And obviously, you need to have redemption rights. You need to make sure that you have very strong integration into the traditional financial system so that you can create and redeem this seamlessly, safely, all the time with a certain service level. Those are important things as well.
Bill, we talk about the future financial system. You have to talk about cross-border payments. We had IMF chief Kristalina Georgieva coming up saying that, make that push for CBDC with cross-border payment in mind. How do you see that evolution?
I think there's a lot. You're going to get me in stereo now. I think there's a lot of possible applications for CBDCs, but CBDC is, in its basic form, is a stablecoin. So, is that the necessary medium of exchange? Can be. The pilots that the Chinese have led, together with Hong Kong, Thailand, UAE, others will join, with ECNY, is using a CBDC for cross-border payment. It's obviously a different set of payment rails than those conventionally used today. It's not dollars. It's not SWIFT. It's something new. Will it take off? It could be. I mean, if you have people who are buying and selling that want to go off over a different set of rails, in that case, it's the digital currencies from those 4 countries. Only ECNY is actively operating right now. But that. It doesn't need to be a CBDC. I mean, I think Jeremy will have plenty of products that will offer the same safe medium of exchange functionality. I suspect that banks themselves will be issuing stablecoins of one version or another. And it'll be a question of the convenience, I think, and the safety and soundness always, but the convenience for the end user in terms of accessing the medium, and having an ecosystem where the instrument is acceptable to both the buyer and the seller.
So traditional banks, central banks, looking at cross-border payments, making it seamless. But you say, Jeremy, that at some point, the whole idea, the whole concept of cross-border payment is absurd.
Okay,
yeah, I mean,
sorry, just before, I should have said, since I do work in a bank, the cross-border payment system, international payments for banks, actually works very well. It's safe, it's sound, it's not as fast as the ultimate end state should be, although it's getting very, very fast, and it's also getting very, very cheap, properly constructed. But so there's the existing payment rails are adapting very quickly to be relevant for the new economy. Sorry, Jeremy.
Yeah, no problem. I think if any of you have used internet services, as I expect many of you have, you're accustomed to a world where you have a piece of software on a phone and you can send a WhatsApp message to someone and it just is there instantly, or someone sends you a link to a website and you don't care what country the website is. There's no such thing as cross-border email or cross-border messages or cross-border web browsing. The concept of that is just absurd, right? We just don't think that way. The internet is internet scale. And if you've used stablecoins, you have that same experience. You are directly interacting, transacting with another counterparty with the equivalent of an email address, a blockchain address, with a digital wallet that you can download from any app store, and there's thousands of these digital wallets, and you're directly transacting. And now with the third generation of blockchains, you can settle a transaction peer-to-peer in about 400 milliseconds at a tiny fraction of a cent in terms of transaction cost. So my comment that I've made publicly and that you're laddering off of is, I think that in 5 years, I don't give it, I can't predict the exact time frame. In 5 years, the idea of a cross-border payment will be as absurd as the idea of a cross-border email or a cross-border web browsing session. And that's because this technology is internet scale inherently. And that's very powerful. And I think users, which will be households and firms, and frankly, financial institutions, as they experience this, they'll say, I don't ever want to go back. This is just a better product. And so that's sort of what I mean when I say that.
So, Jeremy, I'd like you to explain that irrelevance comments to my financial crime regulators.
Absolutely. Well, so this is key, right? So, on the internet today, we have various levels of security assurances. We don't really pay attention to that as users, but for example, there are certificate authorities that issue digital certificates that basically attest to the fact that you're a legitimate operator of a website. And there's levels and tiers of that. And the browser that you use will basically now and then you'll go to a site and it'll be like red flag, and you're like, what is this? It's because they're not actually providing an assertion as to the credibility of the business. And so you have this tiered kind of assurance model that exists. That's what's coming to blockchain transactions. Basically, people who have a digital wallet, they will also carry with them a proof of their KYC status, whether you're a firm or an individual. And when you go to interact with another digital wallet, or you go to interact with a smart contract that's intermediating some kind of financial transaction, you're going to need to prove that. And if it's a certain type or size of transaction, behind the scenes, these mechanisms will need to exchange the record-keeping data. And so that can happen, but it can be done in a way which is more privacy-preserving for individuals and leads to less proliferation of honeypots of data, of personal data around the internet, which is a real problem. So we can improve that system of financial integrity using cryptographic methods, which are, people don't realize this, but the whole use of the internet and e-commerce is all protected by crypto. I mean, that is how the internet became viable, is crypto and encryption is everywhere, cryptographic proofs, et cetera. So that's how we'll address those types of issues. But we need to bring along financial crimes regulators and policies to do that.
Let's talk about regulation and policies. I mean, in the end, it is about trust, having that trust in the system. How do you see regulators playing this out? How will this pan out?
Yeah, I just want to pick up on Jeremy's last point, because I completely agree, and as you know, because we work on this together, the end state is nirvana. In the meantime, I mean, there's a reason that there's no single repository of KYC AML data that just every financial market participant draws from. And the reason is because every individual participant in the system is required by regulators to form their own view on the acceptability of a counterparty. So ultimately, we can attach our certificate to a payee, and that may be good enough both for you as an intermediary and whoever's on the other side. But that system doesn't exist yet. We're building it. We're building it. And this is what, frankly, makes it very exciting, that you got some super innovators like Jeremy and his team with a fantastic ecosystem. And you got some super innovators at banks, like some of the people I work with, who have deep-rooted experience in regulation and financial crime compliance, who can work together to create a much better solution for the customer than either of us could do alone. Now, there's competition, a little bit of competition, sometimes a lot along the way. That's a good thing as well. It keeps us all sharper. Regulators, I have found, overwhelmingly get it. And they know that this is the direction of travel. They know that customers want convenience. They know they want to reduce settlement risk. They know that they want to reduce the timing gaps for all aspects of the financial system, and they want to reduce the cost. So we're all aligned in that. They will need to get comfortable that the tail risks in each case are contemplated by all of us that are participating in the market. And they'll probably want to keep some segmentation as well. But certainly I was here, for, amongst other things, the FinTech Festival, of course, but also for meetings with the MAS and groups of international financiers. And this is what we talked about. How does the MAS, as a regulator, safely and soundly support this innovation? I must say, Singapore is doing an outstandingly good job at that. But their counterparts in different countries are also focused, each in their own ways.
A question here. Given the global use of stablecoins, is it more prudent to implement a global regulatory framework or adhere to country-specific regulations?
I'm happy to jump in on that. I mean, the reality is there is a global framework. The Financial Stability Board, which is the body of the G20 central banks, finance ministries, came up with a set of recommendations for stablecoin policy, and the G20 adopted it. And now the members of the G20, their financial ministries and regulators are taking those globally agreed upon policy standards and putting them into law. So we actually have a framework that is global that is now being put in place. Now, are there variances here and there? There are, of course, local variances, whether it's banking regulation, insurance regulation, or any other type of financial regulation. There are variances, but it is a global standard. And there will continue to be iteration on that because technology evolves, the market evolves, so there'll continue to be iteration. And what we're now seeing, it's very interesting because USDC, for example, is widely in circulation in the world today. And so all of these regulators, they have a lot to say, and they want to work to make sure that if a stablecoin like USDC is circulating in Japan or it's circulating in Hong Kong or the US or what have you, that the regulations in those markets can kind of ultimately, you can have reciprocity. And you have this in banking regulation as well, right? There's a parent regulator, and then there's another regulator that's sort of looking over your local activity. So kind of reciprocity is sort of the next frontier. But the fact that so many of these stablecoin policies are based on the G20 recommendations goes a long way.
Another question? Gosh, we're running out of time so quickly. If Web 3.0 is associated with tokens, what could be envisioned as the next evolution? Or Web 4.0? Gosh.
I'm still trying to understand Web 3.0. And I don't know whether it's 3 or 4, but you mentioned up front the tokenization of securities. And we launched this week a vehicle for the tokenization of government bonds in Singapore. This will be a big market. It's already a big market. The tokenization of existing securities and newly issued securities will be a really big deal because the settlement risk is dramatically lower, the cost is lower, the execution, the ease of execution is better. This is the opportunity to take just very conventional real-world assets and make them more accessible and easier once we build the ecosystem. And that's what we're doing now. I don't know whether that's 2, 3, or 4, but it's to me, it's the immediate future.
as I've been building internet software technologies and platforms since 1993 or so have sort of seen Web 1.0, Web 2.0. Generally, these epochs of the internet are like 10 to 15 years. So I think we're a long way off from what one might call Web 4.0. But I think more relevant, I think we're as echoing a little bit of what Bill said, is we're still in the very early stages of corporations and startups and financial industry participants really figuring out what can be used with cryptographic tokens, with digital tokens, and how those can be used for incentivizing behavior, for rewarding participation, for credentialing, for entitlements, for data exchange, for encapsulation of a financial contract. There's so many different applications of digital tokens and smart contracts. But while the technology has been possible for several years now, it's still super early. So my view is that we've still got another 5 to 10 years of the build out of Web3, and it's still too complicated technologically, and my expectation would be probably a couple of years from now, it will be embedded everywhere that we interact with the internet as users and businesses, and we won't even know, we won't call it anything. It'll just be new functionality that has become available to us.
Bill, the next big move. They say that the next big move for big techs is banking. What's the next big move for banks?
The next big move for banks?
Yep.
Well, I think you've already mentioned the payment infrastructure. That was one where the innovators leapfrogged 1,000 years of banking to offer a different user experience without compromising at all on safety and soundness, and took a big chunk of the payments market, both small value and to probably a lesser extent cross-border payments. So I think that evolution will complete. Banks, of course, are still very relevant in the payments markets because we're linking payments to other useful products and services that customers want. In some cases, can only get from a bank deposit. In some cases, could get elsewhere, but historically and consistently still easier from a bank. It's still easier to get credit cards or personal loans from a bank. Banks are allowed to run levels of leverage, obviously along with associated capital, that the private sector chooses not, or so the non-banking sector chooses not to embrace, probably because they want to avoid the regulation that comes with that. Yeah. So I think melding the new economy applications where banks have or are catching up on the technology front and the user experience with more conventional or even exclusive, in some cases, banking products is the next big phase.
Just one question before we wrap it up for the two of you. 10 years down the road, the financial system would look like, Jeremy?
In how long? I'm sorry.
10 years.
10 years. What will the financial system look
Because you talked about 5 already, so
yeah.
10.
Well, so I'll talk about one thing, which is if you look at the internet, one of the things that the internet has done, which is extraordinary, is in almost every industry that it's touched, it's created marketplaces, multi-sided, platform-based marketplaces that have dramatically expanded the possible participants on the supply side and the demand side of these marketplaces. So if you think about advertising and AdWords, if you think about people who make products and people who buy products, Alibaba and Amazon, these marketplace platforms, content marketplaces, transportation marketplaces, all these marketplaces, they're extraordinary. I believe that digital asset technology, blockchain technology, stablecoins, smart contracts, the things that are evolving now, will make possible capital marketplaces that are radically more, make capital available. And so credit in particular, credit-based capital marketplaces that allow both individuals and firms to access and utilize credit, and people who want to supply capital to that to do that in the same way and at the same scale that you've seen in some of these other internet marketplaces. And I think that will be very mature in the next 10 years.
Bill?
I think in 10 years, the financial system won't look much like it does today. You'll have convenience platforms that will be regulated because they'll become systemic in the marketplace. Whether those are coming out of big tech, coming out of banking, or a combination of the two, we'll see. It'll be interesting cooperation, competition. I think you'll have advice platforms, which will be regulated in a completely different way. Quality of advice, non-capital intensive, infrastructure light, and you'll have credit intermediation, which is a core feature of the banking market today, which is increasingly moving out of the banking sector. When it moves out of the banking sector, it tends to be unleveraged. When it's in the banking sector, it's leveraged. So I think you'll still see a heavy dose of intermediated credit in the banking sector with a substantial element outside. Will it be obvious who's a bank and who's not? No, it will not.
Bill Winters, Jeremy Allaire, thank you so much for your insights.
Thank you.